Welcome back to Financial Fortitude. I'm Michael Acosta, joined by my co-host, Brady Hemmerly.
Today, we're diving into one of the most polarizing topics in personal finance and financial planning in general, whole life insurance.
If you've spent any time online, you've probably heard people say things like whole life insurance is a scam, buy term and invest the difference, or that it's one of the worst financial products ever created.
And to be fair, there are situations where whole life insurance is sold poorly, misunderstood, or simply implemented incorrectly.
But we also think there's a nuance here. Like most financial planning tools, there's a time, place, and purpose for it. And today, we want to have a balanced conversation.
So this episode isn't a sales pitch for whole life insurance, and it's also not a hit piece. We're going to unpack why the product gets criticized so heavily, where those criticisms are fair, and where permanent insurance may actually fit into a sophisticated financial plan.
Welcome to Financial Fortitude, a podcast for high earners, families, and business owners. We're your hosts, Michael Acosta
and Brady Hemmerly. Each week, we bring purpose-driven financial guidance to you so you can be assured you're on the right path. If you're looking to become an extraordinary wealth builder, let's dive in. Michael, I'm pretty excited about this episode because it comes with more nuance, more strategy, more specific considerations, and in general, it's just a misunderstood product in the financial planning world. So it's not as simple as perhaps, hey, how do we get started investing? How does a brokerage account work? It's how does a more financially complex product work? Where does it fit? How does it implement into the rest of my strategy, right? There's just a lot more moving pieces here, and I think that's the fun stuff.
Yeah, and we're not someone who's going to put all of our eggs in one basket, and so I don't think there's ever a situation where it's like, hey, this type of financial solution or strategy or tool has to be something that everybody implements or owns or has on their balance sheet. So this is a very polarizing topic in general, just because in the media and some of the talking heads that are out there will just over-accentuate the product as a whole and more or less tarnish it, when in some instances there is a time and a place for it where it makes a whole lot of sense and offers a ton of value or advantages to families that leverage it.
Yeah, and I think that's ultimately our hope with today's episode, to kind of come in the middle as a moderator or in moderation in some capacity. I mean, the things that I hear if I go onto LinkedIn or go online are whole life is the absolute worst or whole life is the absolute best. Right? And you and I know from a planning standpoint, very rarely is one specific product the very best or the very worst. There's a gray area in between. So I'm just excited to unpack how or when it may be an appropriate tool and how and when some of the pitfalls do occur.
Yeah, because ultimately what we want to do is put I wouldn't say necessarily an end to this good versus evil debate around whole life insurance, but more of when is it prudent to actually consider it.
So before we jump in, for our listeners who really haven't gone down this rabbit hole in any capacity, can you explain what whole life or perhaps permanent insurance actually is and how it may be different from, say, term insurance as an example, as the primary alternative?
Yeah, of course. So from a foundational standpoint, I first want to start with term insurance because that's going to be most commonly known. So term insurance is more or less a temporary solution where an individual goes out and they partner with an insurance carrier to get a fixed amount of death benefit, something that will pay out on the life of the insured, the person who is being covered by the insurance carrier, for some sort of cost, also known as a premium. Okay, now in this graphic that we're showing here on our end, for those of you who are listening in, you won't be able to see anything, but term insurance was initially designed or built off the chassis of what's known as a yearly renewable term policy, meaning every year we get older, the cost of the insurance increases. Now, over time, the insurance industry has evolved and they created what's known as a fixed level term. Something for 10 years, 15 years, 20 years, and in some cases 30 years, where it's just a fixed cost for a fixed death benefit. Now, the reason why I started off in saying that this is a temporary solution is because the goal in many instances is to actually outlive the term. So as an example, if I have a 20-year term as a 35-year-old, my goal is to live past age 55, correct? So in theory,
right?
So the purpose of it is to hedge against the probability or possibility of me passing away within those 20 years. Now, at the time that the policy matures, there's typically two options, two decision points. One, I let the policy lapse because it's matured and it basically expires. Lapse isn't the appropriate terminology. Expire is the appropriate term. Or I can go back into underwriting and try to apply for a new policy, assuming that my health is relatively the same or hasn't diminished exponentially, making me uninsurable. Okay? So one of the risks that you run there in that scenario is being uninsurable in the future or the cost of the coverage going up exponentially. Now, some term policies, again, this is temporary coverage, give policyholders the opportunity to convert some or all of their coverage from being temporary term to permanent coverage. And specifically what we want to focus on today is what's known as whole life insurance when talking about permanent life insurance.
So to break this down simply, what this looks and feels like to me is I'm essentially renting life insurance coverage. I've got a lease that I've signed for 10 years, for 15, for 20, for 30. I'm going to have, let's say, $1 million life insurance benefit. When my lease is up, I don't have insurance anymore.
Correct.
And at that time, I can choose to re-sign my lease or rebuy insurance, or I can choose to just let it expire at that point. Now, if I want to re-sign my lease or rebuy insurance after that 20-year time frame, I'm older. So in theory, the cost of that insurance or the cost of that lease is going up.
Correct. Yep. And if you think about it from a real estate perspective, using that lease agreement analogy, if you signed a 10-year lease, let's just say in 2015, in 2025, if you want to re-sign that lease and renegotiate, the landlord's probably going to increase what you were paying, the going rate, because cost of living has adjusted. Therefore, the rental rates have shifted. Does that make sense? Same concept.
Okay. Yeah, it does. So advantages here then. Why would I lease rather than own? We'll talk about own in a second, but what are the advantages of leasing or renting in this circumstance?
So some of the advantages right off the bat is that traditionally, for healthy individuals who are going to be insured with term life insurance, you can get a larger amount of death benefit from the get-go, typically at a lower cost of coverage.
So less expensive
Correct.
in general. I can buy a bigger death benefit. I don't have to come out of pocket as much because both me and the insurance company are hoping that I live past
Absolutely.
55, right? I hope I do, but the insurance company is essentially banking on that. You're just renting here.
Exactly. So in their minds, there's a high probability that you're going to outlive the policy itself, and so they're ultimately not required to pay out if the policy expires.
So lower cash flow outlay, and then this also seems relatively simple
Correct.
to me. I pay my lease, I get my death benefit.
Correct.
That's really the two drivers here.
The other side of the coin is what is more similar to owning your home, right? And if you want to listen to a fun episode, you can go back into the archive of our episodes where Brady and I basically debate on whether or not it's more efficient to rent versus owning a home in today's current home environment or real estate environment. But coming back to focus on here, term insurance, again, temporary leasing, renting, permanent whole life insurance is very much like owning your home, okay? Owning something for your whole life. That's why it's called that. Now, very similar to term insurance, you're going to have a fixed cost of the coverage, right? Also known as your premium. You're also going to have a death benefit that is tax-free upon death, okay? The difference here, though, is that, especially in this graphic for those who are able to see this, the death benefit increases over time as you continue to pay your premium payments. Okay, with term insurance, your death benefit is static for the life of the policy. Now, the third component of a permanent whole life insurance policy that term does not have is what's known as cash value. Now, cash value is a savings component tied to the permanent whole life insurance policy that accumulates over time by way of premium payments that are being made, as well as potential dividend payments that are being received, especially if you were owning an insurance policy provided by a mutual-owned insurance carrier. Now, as those dividend payments are received and as your premium payments are made, your cash value will increase over time. Now, early on, as you see in this graphic, the blue line represents the cash value increasing over time. The red line represents the fixed cost of the premium over time. Because this is, from a solution or strategy standpoint, a life insurance policy first, there is a cost of insurance that has to be paid for along the way. And so that's why this blue line starts off being under the red cost line for probably about the first 10 to 15 years. And then it starts to eclipse and break through the cost barrier. And now the cash value or savings in the policy has the opportunity to be greater than the amount of premiums paid into the policy on the life of the policy. Now, for policyholders that live a very long life, there is the potential that the cash value in the policy could actually equal the death benefit. That's just basically a fully paid for funded policy over the life of the insured, more or less self-insured over that period of time, if that makes sense.
So yeah, let's break this down. We'll use the same analogy that we were with renting. If I am buying a whole life insurance policy, I'm making a fixed premium payment. And in theory, I'm on the hook to make that payment for the entirety of my life, right? As long as I live, whether it's 55, 65,
Correct.
85. But that cost never goes up, right? That cost is fixed the day that I
Correct.
buy it. So to me, that sounds similar to term. It's a level payment, but it sounds like a mortgage payment,
Correct.
right? When I buy my house on day one, my mortgage payment doesn't increase over time. It stays the same. Now, the longer that I own my home, the more I slowly see it appreciate, right? So over time, my death benefit or my insurance value, what I get paid out when I do die, is appreciating. And over time, as I'm making my premium payments, as I'm paying my mortgage, I'm slowly building equity inside of my home or inside of the policy itself here. Now, for any of our listeners who do own a home, if you pull up your first mortgage statement and you look carefully at it, where do most of your dollars end up going on that very first mortgage statement?
Interest.
Interest. Right? The bank has to get paid first, and they have to get paid first because they have to protect themselves for lending
Correct.
to you. Now, in a permanent insurance policy, there's no interest charges, right? A permanent insurance policy, that break-even point is driven by what Michael had said, is the insurance company's not in the business of giving you a life insurance policy on day one and then paying all of the benefits out on day two, right? To pool their risk or to protect themselves, those first couple premium payments that are made are primarily going towards the actual cost of insuring you or the risk of you dying much earlier
Correct.
than expected. So from a complexity standpoint, why is this more complex, or how is this different from renting in your
In my mind,
eyes?
it's more complex for a couple reasons. One, I would say that there's the added variable of the internal savings component known as cash value, as well as the dividends that are being accounted for. Now, the third way that this becomes more complex than term insurance is because of how it has been portrayed in the media, and in the sense that they want to compare this to a traditional investment in the stock market because the policy has a savings mechanism internally. And I think that that's just not prudent in the sense that you're comparing apples and oranges in that scenario.
So it's more complex because there's more moving parts. It's really easy to look at my rental statement and say, here's the cost of my lease and here's how much the lease is for. My mortgage statement's going to look a little more complex because I have my premium payments, my death benefit is increasing, my cash value equity is growing, there's dividend payments that show up there over time. There's just generally more moving
Correct.
parts. But what I do notice here, at least on the permanent side, on the right-hand side of our graphic, for those who can see our video here, there's no end date. My lease never runs out in this circumstance. So talk to me a little bit more on where either some of the value is there or the advantage is here compared to the term policy.
Yeah, so compared to the term policy, again, we're basically hedging. If we're going to use someone who's 35 years old owning a 20-year term policy, we're hedging that if something does happen to me between now and age 55, that some form of funds, money, death benefit will come in to benefit my family, right? My balance sheet, those who I'm leaving behind. With the permanent life insurance, again, we're betting that we're going to outlive that. So instead of paying for a sunk cost, term insurance, in some instances, it makes sense to pay for something that you know you're going to outlive, right? With a death benefit that will continue to increase over time. Now, I'm not saying that that's what everybody should do, but there is a benefit to that in what I would call the midterm. Now, longer term, think about someone who plans on living until 80, 85, 90, 95. The presence of having a tax-free death benefit that grows over time gives them a different advantage than someone who only owned term insurance and the moment they got into retirement no longer had a death benefit present. One, from a tax efficiency of overall assets on the balance sheet. I'm not saying that whole life insurance is an asset or that term life insurance is an asset. I'm just saying by way of funds that will come back into the estate at death in a tax-free manner. Okay, because when somebody passes away, the death benefit is typically tax-free. Now, for someone who's 80, 85, 90, 95, that adds a different element to their retirement distribution plan and how they view spending money while they're healthier during their retirement years versus feeling limited and being able to spend their wealth because of wanting to make sure that they don't run out of money or that they don't handcuff a surviving spouse or their children if they want to leave some sort of legacy behind.
Got it. So there's a potential application. I'm sure we'll get into that further. But what I'm seeing here from a graphic standpoint, if I think about the best case scenario, if I'm 35 years old, I'm planning to live until 65, 75, 85. So if I'm paying for term insurance, I'm doing a prudent job of protecting my family. In the best case scenario, I spend all of that money and don't ever see it back because I'm not planning to die before 55. With a permanent insurance policy, I'm planning to live past 55, but I know I can't live forever. So I know that paying for the policy over time, I'm not sure when, but I know I will die at some point, and I know as long as I've been paying my premiums, this increasing death benefit's going to show up into my estate somewhere for my spouse, for my kids, for charitable purposes, for anything that I have in mind. So I'd say big picture, right, there's advantages, disadvantages to both. I think where we're headed next is, hey, why does whole life insurance get such a knock or a criticism? I'd say first and foremost, because Michael, it's going to be a question I have for you, but first and foremost, is it cheaper to own or cheaper to rent? Right, that's really usually the first stop in this discussion. If you listen to our buying a home versus renting a home, in general, it's less commitment and it's cheaper to rent. Whereas the permanent policy or owning the home is going to be more cash flow commitment or cash flow heavy because there's a benefit that's always going to be out there in the future.
And just like owning a home, there are risks associated with owning permanent whole life insurance, especially if it's not owned and held for the appropriate period of time. Meaning if I buy a home today and in a year's time I go and sell it, I'm probably not going to make out with everything that I've put into it. Same concept. If you begin a permanent whole life insurance policy and within the next 3 to 5 years you decide to surrender or cancel that policy, you're probably not going to receive everything in return that you've put into it up to that point, right? So you have to understand that going in, and hopefully the advisor that you're working with is overemphasizing that if they present this to you, okay? Because permanent life insurance is a longer term commitment, and you should be able to identify what your break-even point looks like at the bare minimum when deciding to move forward with this.
So let's jump into that further because we know it gets a knock, right? What are some of the pitfalls or the criticisms that you see most often either in the media, or what are the criticisms or pitfalls that you've seen in clients that you've worked with who own something before really coming to you for consultation?
So some of the biggest criticisms that are out there, and some of these are going to be criticisms that are shared from talking heads in the media or from specific blog posts that are distributed across the medical sector, would be that one, obviously, high commissions are paid out to the advisors that help clients obtain these coverages, right? One, it's not 100% accurate, but two, that leads into the policies then being poorly designed, meaning that the policy was designed in favor of the agent or advisor who was selling it as opposed to the actual needs of the client, right? So these are all concerns or criticisms that I think are warranted, especially whenever there's not an ethical advisor keeping their client's best interest in mind. To go along with that, pushed very heavily in front of young professionals. Now, I am not one to believe that this is something that should be led with. There are specific metrics, requirements in my mind that need to be met before someone even starts talking about permanent life insurance, right? Because again, it's a matter of setting clients up for success and always doing what's in their best interest. And it's not a one size fits all. So permanent life insurance may never be on the balance sheets or in the financial plan of certain clients, and will certainly be in the financial plan and on the balance sheet of other clients. It's all situational.
Yeah. If we expand on that further, when I hear oversold or perhaps too much of it sold to young professionals, if we go back to our original analogy, like not everyone's ready to buy a home. You need to establish a basic emergency fund. You need to have enough liquidity on your balance sheet to continue to preserve your options. You need to have enough cash flow in your world to support a mortgage payment. And you need to have the financial discipline and commitment to afford that home over time so you don't end up foreclosing on it. So I'd say when we see policies that are oversold, it's, hey, either a client's gone out on their own and jumped into something before they really had crossed through a series of checkpoints, or perhaps they've engaged with a financial professional who did not ensure that they had crossed all of those checkpoints before getting into a more commitment-driven choice, effectively.
Correct. And the last one that I would say that gets mentioned the most is that these types of permanent whole life insurance policies are recommended prior to individuals even considering maxing out their retirement accounts. I think there's differing opinions within the financial services industry as to whether maxing out retirement accounts is something that needs to be highly prioritized. I think in general, saving across the board is what should be overemphasized explicitly, is that it's more about, are you saving the right amount? And then secondly, then saving in all the right places. That doesn't necessarily mean that it's always permanent life insurance before retirement accounts or retirement accounts before permanent life insurance, because one of the things that you have to take into account is what is the purpose of these funds that I'm putting towards quote unquote savings.
And I think that leads us into our second talking point, which is really beginning to show and share the differences between what a permanent life insurance policy is versus what an investment vehicle or an investment account is. Because I think this is where the real friction is, or the rub is, when we hear this type of conversation, the good versus evil or the better worse conversation is, hey, my investment portfolio is going to perform much better than this permanent life insurance policy. And I think in many circumstances that answer is correct, but the way at least that I think about it and would love your thoughts on it is, am I really comparing apples to apples when I put a retirement investment-driven portfolio against a permanent insurance-driven contract? Like, how does that distinction look, or how do you view that?
Yeah, I would say that it's not apples to apples, that an investment such as owning an investment like the S&P 500 or just equities in general should more often than not outpace the growth of a permanent life insurance policy. Why? Because a permanent life insurance policy is offering more promises to their policy holders than the S&P 500, which means that the insurance carriers have to be more prudent with how they are investing the premiums that are being received from their policyholders and the overall financial wellness of the insurance carrier's balance sheet, so that those promises can be kept and met when death claims are made. So you should not expect, in my opinion, to get a 7, 8, 9, 10, 15% return at any given moment with a permanent whole life insurance policy. Okay? Now, if that's what your expectation is, then you were not informed well. You should do additional research. Your expectations are just off the mark. When it comes to owning permanent whole life insurance, a more realistic expected internal rate of return is going to be somewhere between 3 and 6% over long periods of time. Okay? In some instances, maybe even as high as 7%, and some of that is indicative of what the interest rate environment has looked like over that long period of time. So the internal rate of return of a permanent whole life insurance policy is more comparable to the yields or the returns on longer term bonds.
So what I'm hearing here is, if I go and put my money into the market or just an equity-based portfolio, I have to assume a lot of the risks, right? I can lose money in an equity-based portfolio, but I'm going to get paid for those risks over time if I'm taking them appropriately through a 10% return, a 12% return, a 15% return, whatever it might be for the year. When I'm purchasing a permanent life insurance policy, I'm not taking a risk with those funds the same way that I am with the equity. The insurance company's bearing a lot of that market-based or longer-term performance risk for me. And so in exchange for that, my return, as you mentioned, is going to be 3 or 5 or 6%. And it's based on the policy that I've bought, the interest rate environment, how that carrier's performing. Obviously, there's still risks involved in any purchase. But because I have more certainty and more guarantees attached in the form of promises of future death benefit and cash value, like my return's not going to be the same. If it was, if I could get 15% inside of a contract guaranteed with promises, I don't know if I would go invest in the market because I don't have any promises over there.
Well, and one thing to note, if you go out and invest in the market, you cannot eliminate market risk. And therefore, you are subject to market pullbacks. So you could put $100,000 in the market, and at the end of the first year, your portfolio would be valued at $90,000, meaning that you're ending up with less than what you started. Now, with a permanent life insurance policy, whole life insurance, over time, your internal cash value does not go down, right? It doesn't matter if the market's going down and there's market turbulence and turmoil. It does not matter if the interest rate environment's going haywire. There is zero correlation between the permanent whole life insurance policy, especially mutual owned policies, and all these external variables, right? So again, as you highlighted, the promises and guarantees that are being offered by these insurance carriers come with some clout. Now, again, to say that you can achieve all your financial goals by only owning a permanent whole life insurance policy, I think is purely flawed and misguided, personally.
Yeah, so let's talk about that a little bit, right? Because at the end of the day, let's say we've hit some of those basic checkpoints. We've got an emergency fund. We've got some basic liquidity. We have a commitment and discipline to saving money month to month from a cash flow perspective. Right from there, it's more purpose-driven. If my true purpose or goal is to grow and compound my money as fast and as much as possible, and I'm comfortable with risk, where's the best place, at least in your mind, to accomplish that?
Yeah, well, in my mind, it would be equities.
So again, then alternatively, I've got the emergency fund built. I'm saving with discipline. I've got some liquidity. I understand commitment, right? My goal is to put a longer term benefit in place, save money in a safer position, eliminate risk, right? Where's a potential better place to put dollars that I don't want to put at risk, or I'm not as concerned of growing as much as possible?
In my mind, cash, U.S. Treasuries, bonds, maybe even permanent whole life insurance.
So that's the apples to oranges comparison. And that's where I think in the industry and in the media, we have a challenge is, hey, this policy hasn't done as good as my investment portfolio has. Of course it hasn't, right? It isn't an investment portfolio. It's a contract with promises built in.
If you're going to compare it to anything as far as investment vehicles, it is more akin to a bond, specifically a longer term bond in my mind. So just consider that. Look at the 10-year yield curve and just look at what that's done over the course of the last 10 years. If you go back to, 20 years, whatever it might be. And that's what you should, in theory, expect to generate around the way of the internal rate of return of a permanent whole life insurance policy, or be more closely in line with.
So then let's talk about that. If I could buy a bond or invest dollars safely in a bond or a bond portfolio, or I could put dollars into an insurance policy, if I'm effectively comparing apples to apples there, why would I do the insurance policy as opposed to a bond? Like, where are some of the advantages or the reasons to why I might consider that?
So I would say one of the immediate advantages would be the tax-free death benefit that's associated with it, meaning that if I have, let's just say I'm putting $15,000 a year towards bonds based on my overall household portfolio, okay? And to make it a little bit simpler, I have $100,000 that I invest each year. I'm an 85-15% investor, meaning that 85% of my $100,000 is going to go towards stocks, 15% towards bonds or fixed income. Okay, so $15,000 makes up that 15% of the $100,000 investment. So if I take that $15,000 and I put it into bonds and I'm buying it during a higher interest rate environment, I got to buy that bond at a discount, okay, because of the inverse relationship between the price of the bond and interest rates. When interest rates drop, the price of my bond that I own is going to increase. Okay, so depending on when I buy that bond, I run the risk of interest rate risk. When you put that $15,000 into a permanent whole life insurance policy, one, you don't have that interest rate risk, but two, if I died after that first year, my internal rate of return is going to be massive because I'm going to get, in exchange for my $15,000, a much larger tax-free death benefit.
So there's your advantage, right? If I'm putting money in, let's call it safe bucket, I could put money into a safe bond bucket, and it may oscillate generally, or there may be some volatility there, safer than equities. But if I put money into a safe bucket bonds, if something happens to me, nothing changes. Whatever I put in the bond bucket's there. If I put my safe money into a permanent life insurance policy, same thing. There's not really all that much risk there compared to equities. But if something does happen to me, my family gets a big life insurance benefit. Additional reason as to, hey, why I might consider that alongside of a bond or in lieu of a bond for my safe money,
Right.
that is.
And the other piece of this where there is at least a consideration that is notable is that from a cash value standpoint in that permanent life insurance policy, as you highlighted earlier with the mortgage analogy and owning the home, your cash value is not going to grow much by way in that first year. So you put $15,000 in, it's going to be a fraction of that, of what's in the cash value at the end of year one. Now in year two, you put another $15,000 into the policy, and now that cash value starts to come to life. And at some point in the future, the longer you hold that policy and you continue to pay towards the policy, the cash value starts to grow, or at least has the potential to grow in a sizable manner above and beyond what you're putting into it, especially if it's a mutual-owned company that has a strong dividend rate. Now, bonds don't necessarily pay quote-unquote dividends, they pay more interest, right? So depending on what your bond duration looks like and what the yields look like in that given moment will dictate what your actual interest looks like that's being produced off those bonds. So another way of me saying that there is liquidity risk, obviously, in owning bonds versus permanent whole life insurance, just because the cash value is not going to grow, at least effective immediately, dollar for dollar of what you're putting into it, whereas the bonds could, but the bonds values will fluctuate based on where interest rates are moving in that given moment.
So let's talk about that interest, because I think that's the other primary advantage if we compare both the safe buckets, right? Every year that my bonds produce interest in my portfolio, say as an example, I just have the funds in a brokerage account. What happens there to me on April 15th?
As you're meeting with your CPA and tax filing professional, they're going to ask you, did you have any interest or dividends, right? And if it's a brokerage account, that means it's a non-retirement account. So it's not deferred interest or dividends. These are realized dividends and interest. You're going to have an increased tax liability.
So as my bond portfolio grows and my interest grows, my tax
Correct.
bill grows. In the permanent insurance policy, how does that work? Just very basic.
If the insurance carrier is paying out a dividend, it's all deferred. So it does not show up on your tax filing in the year that those dividends were received.
Got it. So it's essentially protected, not in the same fashion, but in a similar fashion from taxes year to year as a qualified account.
Yeah, I would say from year to year, it's very similar in theory to how deferred growth occurs in your 401k or your Roth IRA.
Okay. Again, not a 401k, right? This is not an equity or an upside position, but the way that the dividends are treated is protected. It doesn't show up on your tax return.
Correct.
Okay. So with all of this in mind then, we have understood a little bit more about how an insurance policy looks, permanent versus term, renting versus owning. We've talked a little bit more of how does it compare against investments, different because we've got apples to oranges here. We've talked a little bit more of the complexities. Again, we mentioned earlier how it works and where some of those advantages are if we're comparing safe bucket to safe bucket, apples to apples. I think this is where a lot of our listeners are going to say, hey, that's me, or maybe that's not me. Talk to me more about where you actually see application of using a permanent insurance policy from a true planning perspective across someone's balance sheet.
Yeah, so I'd say that there's a handful, and the ones that we come across the most, right, now I'm going to pick a handful, are going to be from an estate planning standpoint, right, needing to have some sort of permanent death benefit within the estate or on the balance sheet that is paid out tax-free for the sole purpose of either providing a legacy for a surviving spouse, children, grandchildren, or needing to pay the estate taxes on very large estates.
So let's break that one down. We'll go smaller and larger. Let's say as an example, Michael, I'm 45 and my spouse is 32. We've got a pretty significant age difference. From a longer term planning standpoint, what is the risk that my spouse and I have as we age?
The risk that you and your spouse have as you age is that one of you will predecease the other. And when that happens, not knowing when that's going to happen, there is a reshuffling of the deck that is required for the surviving spouse. And if proper planning is not conducted, things will shift in the surviving spouse's financial world, such as Social Security benefits being adjusted, potentially if the older spouse lives too long, assets being overspent or depleted further, and then upon their death, there is less left over for their surviving spouse for the remainder of their life, especially with that sizable of an age gap. Therefore, if that older spouse had a permanent death benefit on their life, there is a promise in the background that upon their passing comes back into their financial picture for the surviving spouse to replenish and replace as much of, if not more, of hopefully what was spent while they were living, making memories together before the first passing.
Yeah, it's an age gap fix from a tool perspective, right? As we age, odds are, because I'm 15-ish years older than my spouse, I'm going to die first. And my spouse may have quite a long time without me to live. He or she may benefit from an insurance policy that pays out to make sure that they can replace the income that gets lost when I go. If I live way too long, right? If I end up living far more than expected and we've had to spend much more money than otherwise was planned, right? I'm going to go and my spouse is going to continue to live. They're not going to have any dollars left. So the insurance policy puts more dollars into the pocket of the much younger surviving spouse, effectively making sure they can continue down the road of their retirement, knowing it's going to be longer than mine. Let's talk about an estate planning type of conversation. Let's say I'm a high net worth individual. Most of my net worth is tied up in real estate, business, and I would say private deals all over the place. I may have $50 million. Like, how does that fit in a situation there?
Yeah, it's a liquidity fix, because if everything is tied up in private placements or in real estate, upon your passing, when the estate's needing to be distributed, if there's any estate tax due, how are you going to actually generate the funds required to pay those taxes? Now, as of right now, with current IRS rules and laws, the estate tax exemption is pretty high. So this is really more so catered towards ultra high net worth households and individuals or families. But at the same token, let's just say that you pass away and you have 4 children and you have all these private placement hard assets, not necessarily liquid assets, and 1 or 2 of the 4 children just want their share of the cash of what your estate was worth. Well, now the other 2 children have to figure out how do they go out and get the funds required to basically buy out the other 2 children who want out of the estate, who want to cash out their piece, so that they don't have to liquidate the homes and the private placements, the businesses, whatever it might be. So again, it provides and solves for the liquidity need in an estate planning situation. And it's in a tax-efficient manner.
Yeah, it comes in tax-free. And we use real estate as an example, right? What happens if I have a very large estate, most of it's tied up in real estate, I pass away in 2008? My kids
Correct.
or my beneficiaries have to pay the taxes, so they're going to have to start selling that real estate, even if it's at fire sale values, to start paying taxes. So the insurance benefit that sits there forever as a permanent policy basically quickly fixes a liquidity issue. There's money in that can pay the taxes or basically redistribute the estate based on the plans that I have.
And then the other areas where we see this making sense would be for high income earners who are already maxing out their retirement plans and looking for other tax deferred vehicles to park their funds. Now, this can be optimized if you're using it from an asset location perspective, meaning we've already talked about how permanent life insurance, especially with mutual owned carriers, can act like or perform like longer term bonds. We've talked about the efficiency with the interest or the dividends being tax deferred with the permanent whole life insurance versus with owning the bonds, it being taxable for the year in which it was received. We also talked about the elimination of interest rate risk for the permanent whole life insurance where the bonds are subject to it. So if you wanted to do some asset location, you could in theory say, hey, all of my investments or assets that are truly invested in the stock market are going to be equities for growth, and what allocation of my assets were supposed to be dedicated towards bonds for safety and predictability and hedge against the risk of equities could go into permanent life insurance.
Precisely. Yep, so I'd say there, like, what are the big advantages is I'm doing a great job. I've hit a lot of those initial checkpoints. I'm maxing out my retirement accounts. I have excess savings that I want to put to higher and better use. Can I put funds in a tax-deferred space to pick up either advantages on my income tax return? Or can I reallocate my existing allocation to make my total portfolio more tax efficient over time. And as you had mentioned before, pick up a death benefit along the way, right? If it makes sense.
Right.
Now, does it make sense to do that if I am not putting enough money in growth, if I do not have the right asset allocation to begin with? No, right? That's where a lot of
Absolutely not.
the flack comes from in general. It's like, hey, if we're not hitting our basic checkpoints, this very complex planning tool doesn't need to be the forefront of the discussion.
And I will add the last piece is for business owners and business succession planning funding, right? So business owners tend to like permanent life insurance because in general, business owners like to keep a lot of cash on hand in their business. Now, we've already talked about how quote unquote safe the cash value in a permanent life insurance can be, plus the added value of the dividend rate and then the interest being tax deferred or the dividend rate being tax deferred. Okay. Now, as that cash value grows over time, the business owner can actually leverage it. Policyholders can actually leverage it, meaning they can tap into it, they can loan against it, they can take distributions from it, right? There's different rules around the taxability of whether you take a distribution or a loan. That's a topic for a different episode. But the business owners are creating a bucket of capital that they can lean into if they need to get access to capital for expanding upon their business adventures, right? Or if they hit a slow quarter, need access to funds to be able to cover payroll and overhead expenses, they can tap into that knowing that they can pay it back. And the interest rate on the policy is typically fixed for the life of the policy. So there are some policies that have been acquired during the most recent lower interest rate environment where the fixed interest rate on the policy is in the upper fours versus policies that were obtained in the 80s when interest rate were double digit. Those policies are going to have interest rate loans in the sum of probably 10 to 15%.
Got it. So what I'm hearing there is if I'm a high earning business owner, the permanent life insurance, if strategically designed, can be a place where I'm going to park and put my cash essentially to a higher, better use. I've got access to dollars that I would have otherwise just been keeping in my business checking account. I've attached a death benefit to it. If something happens to me unexpectedly, there's some liquidity for my business, and I can finance against my own dollars pretty competitively as that policy and the cash value continues to grow. One more application that I see pretty frequently is when it comes to special needs planning. Talk to me more about some of the advantages or complexities there.
Yeah, so from a special needs perspective, again, it's a permanent promise for the life of the insured. And if you are a family or a parent who has a child with special needs that may never be able to fully take care of themselves on their own, be self-sufficient, will likely need, 24/7 care or assistance or guidance or support, especially financially, then having that permanent death benefit can be very helpful. Why? One of the concerns that often comes into your head, I imagine, is I don't want to overspend my assets because if I pass away, when I pass away, I would like to leave something behind for the benefit of this child.
There needs to be enough.
They will need support.
Yeah.
There needs to be enough. And so what does that do to you if you do not have the presence of a death benefit or enough assets? Well, one, you underspend while you're living, which may or may not be problematic, but it may also hold you back from fully experiencing life during your golden years. Okay? If you have that permanent death benefit set aside, it is a very efficient form of wealth that can be transferred for the special needs child in a tax-free manner. I can't overemphasize that, right? So instead of leaving your special needs child or your children in general a very fat and healthy pre-tax IRA, the life insurance policy is going to be more tax efficient as far as transfer of wealth.
Yep. I would say it just ensures that regardless of the risks that you take, the experience that you have with your investments, the spending that you do, it provides that, hey, end of the day, my child is going to be taken care of because they're the one person that I truly need to make sure is financially secure if I'm not around anymore.
Correct.
Okay, so what have we talked through up to this point? I'd say first and foremost, what is permanent insurance and how does it look and work compared to its alternative term? That's where we really use the analogy between owning and renting. We discussed how permanent insurance does not compare apples to apples with an investment vehicle, right? It compares apples to apples with safer dollars, a bond or cash or something similar. We talked more through how does it work from a complexity standpoint, where are some of the benefits, and then who or where does the actual strategy-driven decisions apply to? And then lastly, I would say we just talked more so about when and how does it begin to fit into a financial plan, right? We kind of talked about that the whole way. So, Michael, if you have a couple of takeaways for our listeners in this episode, what are some of the things that, hey, I listened to this episode, I've now got some more insight, what should I know or what should I take with me when having this conversation with a business partner or a friend or family member?
Yeah, I would say that you should always do your own research and try to get as educated as possible and surround yourself with professionals that truly have your best interest in the forefront, right? Who are taking the role of educating you on both the pros and cons of every financial decision that you decide to go into. Because at the end of the day, a screwdriver is a terrible hammer, right? But that doesn't make a screwdriver a bad tool. It just means that it wasn't the appropriate tool for that given need, okay? And so the problem isn't so much that whole life insurance is a bad thing or that too much of it is a bad thing. It's that if you haven't foundationally defined all the steps or taking all the appropriate steps to then have that discussion for permanent life insurance, then you may be putting the cart before the horse. There is a time and place for it. And if you don't feel that your situation warrants it, then you obviously might want to do more research or make sure that you have full clarity on why the individual who's putting it in front of you thinks it makes sense. Our opinion of the matter is that when it comes to insurance planning in general, that one, insurance should not be compared to investments because they aren't one and the same, as we've noted and overemphasized in today's episode. But also, what matters most is that given where you're at in your life and what your goals are, making sure you have the right amount of death benefit, in my opinion, is more important than having the right type of coverage, right? Meaning term, temporary coverage versus permanent whole life insurance. So we always believe that we want to make sure that our clients have the right amount of death benefit based on where they're at in life and what we're solving for, and then start to design the coverage in a way that aligns with making sure that they have the right type of coverage. For most and many of our clients, it's starting out with term insurance first, and then at a later date converting if it makes sense, or needing another tax-deferred area to defer funds, or even a retirement distribution plan standpoint. That's when those conversations are coming up.
Yes, I would say big picture too, to kind of piggyback on what you mentioned there, is making sure that you have a professional in your world that understands all of the products that fit within your financial picture, right? There are going to be some financial professionals who truly have an investment background, right? That's their bread and butter. That's their expertise. They may not have as much knowledge on how insurance works or perhaps how it fits inside of a plan. So understanding, hey, from a planning perspective, I'm speaking to someone who understands how all of these pieces and tools actually work, and then stepping in and saying, hey, what's the purpose and what are we solving for here from a goals perspective and a true family financial planning perspective? And then it begins to look a little bit easier. Hey, there's a nail over there. A hammer goes to that. And hey, there's a screw over here. The screwdriver is going to go over here. So I'd say big picture, a lot of the distaste that comes from permanent insurance, as you kind of mentioned, is just, hey, getting into it too early, not understanding what we're buying, not understanding the purpose of the funds that we're putting into it.
Well, Brady, hopefully this episode helped bring some balance and nuance to a topic that usually gets treated in extremes online.
And at the end of the day, financial products, again, just tools. The real question is whether the tool fits the objective, the cash flow, our overall risk tolerance, and our long-term plan.
And if there's one takeaway from today, it's this: avoid blanket financial advice from the internet without understanding your own situation first.
And if you enjoyed today's episode, make sure to subscribe, leave a 5-star review, and share this episode with someone who's ever wondered whether whole life insurance is a scam or simply misunderstood.
And if you got questions you'd like us to tackle on a future episode, head over to www.genesiswealthplanning.com/AMA.
And until next time, keep building your financial fortitude. Are you considering hiring a financial advisor? If so, be sure to listen to episode 1 of Financial Fortitude. In this episode, we discuss the reasons why many people choose to hire a financial advisor and highlight the key qualities you should look for in the financial professional you decide to work with.
This podcast is for informational purposes only and is not to be construed as tax, legal, or investment advice. Although the information has been gathered from sources believed to be reliable, please note that individual situations can vary. Therefore, the information should be relied upon only when coordinated with individual professional advice. Guest speakers and their firms are not affiliated with or endorsed by Park Avenue Securities, Guardian, or Genesis Wealth Planning LLC, and opinions stated are their own. Guardian, its subsidiaries, agents, and employees do not provide tax, legal, or accounting advice. Consult your tax, legal, or accounting professional regarding your individual situation. All investments and investment strategies contain risk and may lose value. All scenarios and names mentioned herein are purely fictional and have been created solely for educational purposes. Any resemblance to existing situations, persons, or fictional characters is coincidental. The information presented should not be used as the basis for any specific investment advice. Michael Acosta and Brady are registered representatives and financial advisors of Park Avenue Securities, LLC, PAS. Securities products and advisory services offered through Park Avenue Securities, member FINRA, SIPC. Financial representative of the Guardian Life Insurance Company of America, Guardian, New York, New York. Park Avenue Securities is a wholly owned subsidiary of Guardian. Consolidated Planning Group, Inc. and Genesis Wealth Planning, LLC are not affiliates or subsidiaries of Park Avenue Securities or Guardian. Michael Acosta's California Insurance License Number 0M50974 and Brady Hemmerly's California Insurance License Number 4353077.
7237198.35 expiration 528.